The average credit card in 2026 charges around 19 to 20% interest. A mortgage on the exact same person's house might charge 6 or 7%. That is not a small gap, and it is not random. It comes down to one structural difference most people never think about. A mortgage is secured debt. If you stop paying, the bank can seize the house and sell it to recover most of its money. A car loan works the same way. The lender can repossess the vehicle. A credit card has no such backstop. When you stop paying credit card debt, the issuer has no house, no car, no physical asset sitting behind that balance to seize and sell. The debt is backed by nothing but your promise to pay, which is exactly why it is called unsecured debt. And it is the single biggest reason credit card rates run so much higher than mortgage or auto loan rates for the exact same borrower. A mortgage lender knows almost everything up front: the exact amount borrowed, the exact monthly payment, the exact payoff date years in advance. A credit card issuer knows almost none of that. They don't know how much of the credit limit you'll actually use, whether you'll carry a balance for 1 month or 5 years, or whether you'll pay it off in full or make minimum payments indefinitely. That unpredictability is itself a form of risk, separate from the unsecured debt problem, and lenders price uncertainty just as aggressively as they price default risk. A loan with a fixed schedule is fundamentally easier to underwrite than a revolving credit line with no fixed end date. Credit card interest rates aren't pulled from thin air. Most cards use a formula: the prime rate, which moves directly with the Federal Reserve's benchmark rate, plus a margin set by the card issuer that typically runs somewhere between 12 and 13 percentage points. So when the prime rate sits around 7 or 8%, a typical card lands in that 19 to 20% range almost automatically. That margin is where the issuers profit, their expected default losses, and their operating costs all get bundled together into one number that gets applied to your balance every single month. Here's the part that frustrates a lot of cardholders. When the Federal Reserve raises rates, credit card issuers pass that increase along almost immediately, often within a single billing cycle. When the Fed cuts rates, the decrease trickles down far more slowly, and issuers are in no hurry to pass along the savings. This isn't a coincidence or a processing delay, it's a deliberate business choice. Issuers already priced in a wide profit margin, and there is no competitive pressure forcing them to lower rates quickly when nothing requires them to. The result is a ratchet effect. Average credit card rates climb quickly during hiking cycles and stay elevated for a long time afterward, which is part of why the average rate sat above 19% through much of 2026, even as other loan categories moved more with the broader rate environment. The rate itself is only half the story. Credit card issuers are required to set a minimum payment, and that minimum is deliberately structured to be small, often just 1 to 3% of the balance plus that month's interest. Making only the minimum payment on a several $1,000 balance at 20% interest can take years, sometimes decades, to pay off, and the total interest paid can end up exceeding the original amount borrowed. This isn't a hidden trick. It's disclosed in the fine print on every statement. But the math is genuinely counterintuitive to most people looking at a monthly bill that seems manageable on its surface. Given how expensive this debt is, an obvious question is why so many people carry a balance at all instead of paying in full every month. The honest answer is that credit cards are often the only unsecured credit readily available to someone facing an unexpected expense: a medical bill, a car repair, a gap between paychecks without collateral, or a lengthy approval process. A personal loan or a home equity line might carry a lower rate, but both require qualifying, some collateral or credit history, and time to process, none of which helps someone who needs money today. Credit cards fill that gap, and issuers know it, which is part of why the pricing on that convenience stays high regardless of what happens to rates elsewhere in the economy. A common assumption is that a great credit score should unlock a dramatically lower credit card rate, closer to what a good mortgage borrower gets. In practice, the spread between the best and worst credit card offers is much narrower than people expect, often just a handful of percentage points, while the spread in mortgage rates between excellent and poor credit can be far wider. That's because the underlying structure, unsecured, revolving, unpredictable, applies almost equally regardless of how strong your credit history is. A perfect credit score reduces the issuer's default risk, but it does nothing to change the fact that there's still no collateral behind the loan. So even excellent credit tends to land somewhere in the high teens rather than dropping anywhere close to mortgage territory. The next time your credit card statement shows a 20% interest rate next to a 7% mortgage rate on the same piece of mail, remember it isn't arbitrary. One loan has a house behind it. The other has nothing but a promise, and that difference is worth more than 10 percentage points a year.